welcome to the show.
All right. 19 January.
I don't know what year it is.
At least I got the right year on the slide this time.
Oh, did you?
I think it was last week that I
it
was still in 2024 time.
24. It happens.
Yep, dude. It's been crazy beginning to the year. All kinds of volatility. And market is trying to decide which way it's going to go for the year.
It's just sliding sideways.
Yeah.
Sliding into the new year.
Yep.
What do you got for us?
All right. We're going to take a look at what happened this week. There's actually a lot of good economic news. Not expected, but a lot of good economic news. And the three most important things for the year are going to be the dollar, the treasury bond yield, and the unemployment rate. So we're going to take a look at those three things. And last week we did some head and shoulders patterns because at the time those were looked like they were gonna, or they were forming, right? And so patterns evolve when we talked about it last week. The head and shoulders can turn into a sideways consolidation or a bow flag pattern or whatever. So Bitcoin is a good example, and we're going to show the evolution over the past week, basically, of the pattern, the head and shoulders pattern on Bitcoin, and then the TSP fund charts. So Monday, consumer inflation expectations. So that's like what all of us think inflation is going to be like. It stayed at 3%. Consumers basically have been thinking, based on a survey, that 3% is going to be where we're at for the foreseeable future, and it's been that way since last June, except it had one slight downtick in October. So there wasn't a whole lot of other interesting information on Monday. S&P was up 0.16%. Tuesday, pretty big day, producer price index. So the inflation rate for producers month over month and year over year came out slightly better than expected, but it was still pretty high. Business optimism index, which is a pretty important index in terms of what business owners think the direction of the economy is, was up to 105.1 from 101.7 last month, and it's really exploded over the past 2 months. I mean, it's turned up quite a bit since November. So that's certainly bullish. Can't read that any way other than business owners are bullish on the economy going forward. Core PPI month over month was really what kind of moved the market on Tuesday. S&P was up 0.11%, but this is a core producer price index, right? So if it's going down, it means that inflation into production costs is decreasing, right? So that's good for not necessarily good for the consumer, but it's definitely good for companies, and they have less inflation, and so it makes sense that stock prices go up as this continues to go down, if in fact it does continue to go down. And then Wednesday, I don't know how people are doing it. 30-year mortgage is back up above 7%, 7.09% this week. It was up from 6.99 last week, and people are finally throwing in the towel, basically. Mortgage applications exploded 33%. They had been down 3.7% last week and 12.6% the week before. But they exploded to the upside, and that's kind of what it looked like. So a whole lot of people, and I actually got on ChatGPT and tried to figure out if it was, is it BlackRock or I keep forgetting I think it's a subsidiary of BlackRock, but it's called something else, right? Something Rock.
Yeah, I mean, I think it's still them, but yeah, buying up all the houses.
Buying up all the houses and stuff, right? So I was trying to force ChatGPT to tell me if it was residential purchases or commercial, BlackRock investor, private equity, something other than individuals buying houses. That's a huge spike. So that's mortgage applications. So, okay, mortgage applications. Probably not BlackRock because they generally don't do mortgages. They just buy it.
Yeah, the way you can see it is, at least the way I've been able to find it, is you look at how many houses or homes are being bought in cash.
Yeah.
And so there's certain cities that are, obviously bigger than others as far as that happening, and that is investors coming into those certain sections throughout the country because they just see it as a potential for whatever, right?
Mm-hmm.
And so there's definitely some cities that are getting, hammered with cash purchases, which, really, like if, let's say a regular person is trying to buy that house, they can't because they can't compete with a cash offer because they'll just, they walk in, cash, the deal's done. Right. There's no waiting on anything. And, it kind of sucks for the average, home buyer that gets caught up in that. But to back to your statistic here, that looks like it's because it's mortgage applications, it wouldn't be investors.
Right. So mortgage applications, that I think is even stranger. I mean, everybody, the affordability of housing unaffordability is at all-time highs, right?
Yeah, right.
Affordability is
especially
all-time
around
lows,
here.
Right? Yeah. So everybody's looking at interest rates because if prices kind of stay where they are, the hope is that interest rates come down so that at least if prices stay the same, your monthly payment is coming down a little bit, and maybe you can afford it, right? But rates going up to above 7, people are like, screw it, I can't. What if it goes to 11? Like and price doesn't come down, then what am I going to do? So apparently a whole bunch of people thought that same thought this week. And we got a spike of 33% in mortgage applications.
I mean, when it stays that low for that long, you're going to have these spikes because people are sitting on the sidelines. I get realtor friends who tell me they've got so many customers right now, clients that come to them, and then throughout the process figure out, hey, I'm gonna sit and wait for another month or two, whatever. Like they don't have to move, but they want to move. And that kind of thing, and then all of a sudden they just come out of the woodwork because they're like, okay, I can't wait any longer.
Yeah.
Like we got to change for whatever reason.
Yeah, there's all kinds of reasons why people move for sure. Yeah, so I don't know. That's one piece of the economy, right? Obviously, the more you pay per month for housing, the less you can spend on other things. So, where was I? Core CPI was really the kind of the headline for Wednesday. It was up 0.2 after being up 0.3 for the past 4 months. It was all anybody talked about on the news. I don't really get why it was that big of a deal. But the S&P was up 1.83% on Wednesday. Thursday, initial jobless claims were 217,000 versus 203,000 the week before. So and if you remember last week, unemployment had dropped from 4.2 to 4.1%. So initial jobless claims at 217,000 is pretty average. And S&P was down 0.2. And then on Friday, housing starts. So there's a lot of housing information this week, right? Housing starts, which is the new houses being, housing permits is a different stat, but housing starts is new houses being built. I can't remember if you have to have dug the first shovel of dirt or what for the stat to begin, but housing starts had been falling consistently since peaking in April 2022. So builders definitely were not building, right, which contributes to limited supply and keeps prices higher. But on Friday, we had another monster move. We'd been declining, so this is only going back to 24, but if you did the 3-year, it was steadily going down until... So maybe there's something with housing starts. Maybe a lot of those people were buying new construction. I don't know, but that there's got to be some kind of correlation there between a giant rise in housing starts and a giant rise in mortgage applications.
Yeah, I just started seeing a bunch of new houses being built in my area. I live kind of out in the country now, and the new houses that are being built around where I am are just massive size, right? Yeah. I mean, because they're 3-acre, 4-acre lots, and I mean, it's real crazy. And I saw this like, I thought it was a commercial building going up. That's how big it is. And then,
the house.
The house.
Yeah.
Like I thought it was an office, building. And then it's a few roads down, and I drove around, and then there's like 3 more being built.
Yeah.
And these lots have been empty for at least 5 years. And I was like, wow, where's all this coming from? Like, I mean, one house being built, it's like, oh, okay, right. But like 3 mega mansion looking places, I mean, it was crazy. And so, yeah, I wonder, I mean, I don't know what what the spike comes from, right? That's the hard part, figuring out like where is this coming from. I'm sure somebody knows, some analyst, but yeah.
Yep. Fascinating what is going on in the economy. But I think it comes down to three things, and the first one is the dollar. So this is the dollar, the price of the U.S. dollar compared to a basket of other currencies, basically, is what the DXY is. So that's the ticker symbol for the dollar is DXY, and that's in candlesticks right here. And this is the S&P 500 in red. Okay, so if you go back, a couple things I kind of wanted to point out here. The stock market tanks from COVID. Okay. The dollar goes up because people are fleeing to the safety of the dollar. So anytime we get a big, anytime the dollar is going up, basically the S&P is going down. And when the dollar starts falling, the S&P starts going up. Okay. Just like here after COVID, once COVID bottomed, the dollar peaked, dollar starts falling, S&P starts going up, right? It's not one for one, it's not every day, but when the dollar is going up, it's a headwind for stocks. So recently, stocks have been going up in spite of the dollar going higher. So you can either look at that as, well, stocks are super strong because they're going up in the face of the dollar. You can say that it's basically stocks are getting ready to roll over because they just haven't responded to what the dollar. There's all these different ways you could interpret it, right? If the dollar starts falling from here, that in every other instance, when the dollar falls, right, the stock market goes up. When the dollar falls, the market goes up. So if the dollar was to fall from here, the market ought to rally. So we shall see. If the dollar goes down, it's definitely a headwind for stocks. Tailwind for stocks. Second one's 10-year treasury bond. Yield. The yield on the 10-year treasury bond. So we've talked about this quite a bit. The yield bottomed down here at like 0.5% in 2020. It came up in a 1, 2, 3, 4, 5 Elliott wave pattern to a top at 5%. That was back in October 2023. And it was also the low for the S&P 500 that year, right? Since then, yield has gone, it's basically done this I think it has to be a bull flag pattern at this point. It's outside of this channel. Okay, so it's definitely outside of that channel. So this is one trend. This is another trend. Whichever way it breaks will be the next direction for yield going forward, right? If it breaks up, it's in line with higher interest rates. It's interest rates. So especially if we get back above 5%, if we get back above this 5% level, it keeps going up. Can it roll over from here? Sure. Can it roll over and come back down to the channel and keep going back up? Yep. There's all kinds of things it can do. But in the short term, everybody's looking at that 5% level, because if we get back up there and tag it and roll over, that's fine. If we get up there and keep going, it causes all kinds of problems, mostly for the Fed and the Treasury, because it costs way more to finance debt. But for us little people, if rates keep going up, mortgage rates keep going up, credit card rates, car loan rates, everything. So it's definitely something to keep an eye on. And then when yield goes up, bond prices go down. So the F fund goes down when yield goes up. And then the unemployment rate. So we talked about this a few times. Going back to 1948, right? The green vertical lines are recessions. So every time the unemployment rate starts accelerating to the upside, we get a recession, right? Every time. There is never a time when we hit a bottom, turn, and then roll back over, right? You don't see that anywhere. Every time we hit a bottom, we go significantly higher. right? Every single time. This right where we are right now, as of the last couple of weeks, is interesting because we've hit a bottom, obviously, and we started accelerating to the upside, and we got a tick down last month from last week actually, from 4.2 to 4.1. So in the world of possibility, is it possible that unemployment can roll over and start coming down, and we can avoid, this uptick? It rolls over, and we avoid this recession. Is that possible? Sure, it's possible. It's never happened going back to 1948. So, in my opinion, the biggest thing this year is going to be the unemployment rate. If we continue higher in unemployment, eventually we're going to get this recession. Okay, those are definitely the top three things to watch as we go forward. All right, so evolution of patterns. So this is the chart we put up last week of Bitcoin, and it was a really good example of a head and shoulders pattern. You got a big run up to a high, which gave you the beginnings of a left shoulder, pulled back to this support level, right? Went on to make new highs again, which became the head, pulled back to the same support level, right? So now you got a whole bunch of lines that you could connect and draw the neckline. Rallies a little bit, gets back basically to the same level as the left, and now we have the right shoulder. Came back down again, tested that neckline again. So the head and shoulders topping pattern, it's basically showing that there's strength coming into this part, and then there's a lot of support, right? A lot of buyers here at that price, but the right shoulder is showing that the momentum behind this move is weakening. And all that it takes is a break below the trend line and price keeps going lower. But you have to have the breakdown through the trend line. So this is where we are. Same chart, but I'm going to talk about a couple things. The same idea. This was the left shoulder. This was the head. This is the right shoulder. We got basically a fake out on Monday, right? Broke the trend line, came back up, and then has kept on going. So the evolution, I'm saying, this now becomes actually a bearish triangle, right? It's a triangle, and technically the market can break out either way out of a triangle. They call it a bearish triangle because the bottom line is the only thing that's holding everything up. As price puts in lower lows, every time it tries to make new highs, it gets rejected, and then the idea is that the majority of the time it'll break down, but it doesn't always. So it looks like this is as of Friday, right? Friday, like, I don't know, 10 o'clock in the morning. It looks like Bitcoin is breaking out to the upside. So if we put it in a little bit bigger context, we do two things here. This is the bottom of we're back here in March of last year. So you got 1, 2, 3, 4, 5, 6 months of sideways to down consolidation in Bitcoin. That's a pretty long time. And it went from about 75 down to about 50. So that's a pretty big move to the downside. So you had this long sideways consolidation. And then you had a 1, 2, 3, 4, 5. It looks like what's happening. So the Elliott wave count may or may not be right, but you got this long consolidation, a first move higher, a consolidation, the next move ought to be higher in this kind of time frame. So if this breakout holds, especially if we get above this high, we keep on going. Does that make sense? All right, TSP fund charts. So if you're following along on a weekly basis, it has been quite the past couple of weeks. But the 20-week moving average line has held support ever since we got above it right here in October, November 2023. So this is a weekly chart. Each one of these ticks is 1 week of price action. The blue line is the 20-week moving average line, and you get the relative strength technical indicator down here. So every time, once we got above that 20-week moving average line, every time we came down, we got support at it. And we got support this week, right? So as of right now, the overall trend is up. Relative strength, I wouldn't say it's rolling over, but there's not as much. Obviously, there's not as much strength in the rally as it was back here when it was kind of earlier on. And it would make sense that as relative strength, as the market is the kind of momentum behind the continued move higher wanes, relative strength starts rolling over. But we've been talking about that for a while, and price continues higher. So we also got support right there at the 20-day, and we're almost at the 50 on relative strength. So that's enough of a pullback to relative strength that it can kind of reset, and relative strength can keep on moving higher, and price can keep on moving higher. All right. S fund, same kind of thing. It was a big pullback. We had a big move up on election week, rallied for about a month, rolled back over hard, and got support at the 20-week moving average line again, and right there at 50 on relative strength. So for now, the rally in the S fund continues. I fund breakdown has been going on for quite a while. Once we got below the 20-week moving average line there, pulled down, corrected back up, hit resistance at that line, pull back down. I mean, we're below 50 RSI and below the 20-week moving average line. So the I fund is not the place to be. And F fund is in kind of the same boat. Again, if the F fund goes up when yield goes down. So if the 10-year yield rolls over and interest rates start coming down, that would be great. That would be a big win for the F fund. And it would probably also push stocks higher. So there's so many things in play. It's very hard to keep track of them all the time. But the dollar, yield, and unemployment. And unemployment, I really think, is going to be the biggest one. And the G fund, of course, always goes up and to the right. As interest rates continue to rise, your rate of return in the G fund rises. So there's another thing called the equity risk premium that I think is pretty interesting. If you take the earnings per share of the S&P 500 right now, which earnings per share 28, I think it's earnings per share. If you take earnings divided by your earnings minus the 10-year treasury yield. So basically what you're trying to figure out is your expected earnings on the S&P minus your guaranteed rate of return on a 10-year treasury bond. Which one has, obviously the treasury bond has less risk, and right now it's like 3.5% is the equity risk premium, but the treasury bond is like it's like 4.8%. So it's negative. It's actually, from a risk reward perspective, you're better off in treasury bonds right now. So again, it's just there's all kinds of different ways to value what you're looking at. And 2025 is going to be volatile, so it's going to be interesting to see if people decide to just park it at 5%, 10-year and call it a day, which is essentially us going to the G fund.
Yeah, I mean, it's not a horrible idea sometimes.
Yeah. Right. That is all I got.
Questions. If you have any questions, you can put them in the comment section wherever you find the video. If there's no comment section, shoot us an email, support@growmytsp.com, and they will get it over to us, that cool support team that we have.
Yeah, we do.
All right, guys. Hope you have a great week. Like the show, share it with your friends. Going to be a lot of things going on these next few months. I mean, I'm kind of ready to get into the year, right? We've had a whole lot of just kind of, let's just get into it. New guy comes in next week.
Yeah, it's on Monday, so it's going to be.
Who knows?
It's going to be fascinating to watch.
It's going to be a wild ride.
Yeah.
All right. See you guys later.
All right.